Hi, everybody. Welcome back to another episode of the Discovering Multifamily Podcast. I'm one of your hosts, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Alex Moore. And Alex is the founder of Greywhale Capital, who works with accredited investors and family offices to securely place capital into multifamily real estate. She acquires both Class B and Class A multifamily apartment buildings in primarily Texas. And they're all, value add opportunities that help improve the community, help, create, above market risk adjusted returns for investors. And Alex is actually, she left a medical career. She's coming at us from the Bay Area, and we definitely want to hear her transition from the medical healthcare industry to real estate, because they're two different things, like very different things. I could speak from that from sort of experience, and very interesting to see how she was able to leverage some research, to kind of bring the healthcare component to real estate. And she has about $80 million under management right now, with hundreds of doors, and really excited to see what she's been working on and how she got into it. And so we could just go from there, Alex.
Hey, thank you so much for having me. I really appreciate it, Anthony. I was looking forward to this. So, you're right. I come from a medical background. I'm a nurse practitioner. I've been in internal medicine for over 10 years. Nursing was a great career. And I think a lot of folks find a lot of intrinsic value in that, but it's pretty high burnout. And so I really was looking for an alternative to that. And I never really did this passively. I've always been an active acquirer. So I started with my first investment property by accident. We rented out our single family home. And then from there, got interested in what it meant to have more doors for more security and having less reliable, more resiliency when it comes to, hey, I've got a vacancy, I still have to carry my debt. So obviously need more units. And so got into that, but I did a little bit of everything. Honestly, have explored almost every asset class. And I think that offers a unique perspective on what is a benefit to that asset class and what is a risk when you actually are doing it. So I just fell in love with what you can do with a property, bringing the performance up, but also transforming the community in that time as well. Because you're definitely providing better housing for people and
Sure.
Doing that actively. You really realize that, hey, some of these assets aren't taken care of at all. And you're addressing some major concerns for tenants and making their lives a lot better too. So huge into that. That's also, I think, going back to medical, like you really care about people. You're like, I'm doing this for the finances, but also because you want to create good places for people.
Sure. So talk to us about some of the assets that you have in Texas and Phoenix.
Yeah. So they're both multifamily and they're both value add, but they were a little bit more unique because both markets are so hot right now that there was a ton of just intrinsic growth from just acquiring them, that even though you could do work on the properties, they had a lot of natural rent lift to them. So particularly the last one in Houston, that was a direct from developer purchase. And so there was organic rent lifts that happened there. And then it's been doing really well because the leases are trading out at, over 10%. This is a unique time. I will not say that this is going to be a forever thing. And so I think a lot of people are riding that organic rent lift. But I, want to caution that in the future, it may not be that way. I would be really cautious with underwriting right now, especially with the way that financing is. So take that into account for folks who are looking for their next thing.
Sure. No, definitely. And that's a good point. So what type of projects are you working on now? And how are you trying to mitigate the risk of, the interest rate increases and kind of just the economic risks right now in general? So you're in two really good markets, which I think you'll be fine in. Not every market's like that. So you'll probably still, make up with rent increases still. And like you said, there might not be 10% a year, but there's still a supply and demand imbalance. And
exactly. That huge, the forecasting for where rents are going to be is going to be consistently increasing just because of that supply issue, like you mentioned. But taking a look now as the interest rates have risen, we're seeing that the cap rates haven't really changed at all. And so anticipating a future spread in that cap rate is really important. I think a lot of people don't spread their exit caps. And so I think we'll see a little bit of a pinch coming in the future because folks haven't anticipated that coming up. And it's important to really know what kind of financing you want to put on a product and then understand what that financing means. So for bridge debt, you're going to have that float on the SOFR. So we always model out the SOFR for the entirety of the hold period. So that tells us whether or not the asset can sustain debt service and whether or not we're still going to get cash flow to investors while being on top of the SOFR if it's bridge. And of course, if you're going to fix, it's a little bit easier to model out. You've got your rate, but then you have to also consider, hey, if you had an opportunity to sell early, you're going to have to pay some prepayment penalties for that. A lot of times, if the deal is big enough, it can sustain that, but you really have to take that into account that there's going to be some loss on the back end because you had less risk up front. And it depends on your investors. Some investors are willing to take a little bit more risk. Some of them aren't. So for family offices, they may want to put long-term debt on it upfront at a fixed rate, or a 7-year term, saying, hey, we'll hold for 7 and then we'll just sell it. And that might be the right thing for the investor. So it really depends on who your investor is, what their goals are of the investment.
Yeah, no, that makes a lot of sense. And every deal is different. And so what types of holding periods does your firm focus on? What do you focus on?
We do a model of a 5-year hold with a 3-year refinance. That's been the historic model that works well for value add. Bridge is still looking like a very competitive thing in most circumstances, but we're kind of starting to see that shift where it might make sense to do the long term. There's also a fixed bridge product that we're looking at too. So that offers some stability. You get a little bit higher rate up front, but then it's fixed throughout the term. I like that idea. And especially when we're seeing that the SOFR could go up to 2.7 right now. And so we take an average to kind of see where is the most likely rate that we're going to be getting on average. But so if that average is higher, then it might be worth going for that lower initial rate. So I think that's an interesting product. You probably have explored it too.
Definitely interesting options right now. Definitely, markets have changed a little bit. And in terms of where, like you mentioned, so you got Texas and Phoenix, and in terms of how you mentioned, you started with your single family home. It's like, I guess, did you start right away into the big multifamily? Like after that, like how would you? I guess we kind of skipped over that a little bit.
Yeah. So we had, for doing this, going from single family homes, it was just one, and I realized that it was a lot of liability there. So when I did my first, it was a duplex. And I thought you had to buy it all cash in order to be competitive. So what ended up happening was I did buy it all cash, saved up for it. And then I did a refinance out almost immediately. I closed it and then refinanced out the equity and purchased a short-term rental at the same time. And so I didn't really know which one at that time would be the thing that I enjoyed the most. And also the play is a little bit different. With short-term rentals, you're dealing with high cash flow. And then with long-term, you're doing a combination of cash flow plus you're getting some appreciation there too. And I think when you're modeling those out at the beginning, obviously you're like, oh, this short-term rental is going to be fantastic. But then we've held it since we acquired it, and the pandemic was really a light on that because the short-term rentals that we have are in Maui and no one could travel for the first year of the pandemic there. So it was completely on lockdown. So you have no cash flow during that time. So that's why reserves are so important to have. And it really brought to light, hey, that's something that is a luxury for people, and it's not always a guarantee. With the long-term family holdings that we had, I built out several properties. So what I did was put equity into it, did a CapEx plan, then refinanced the capital out, got another one, and did that several times. And what that did is it provided stability across the number of doors that you have. Problem is that you also have multiple roofs. So again, when a roof comes up, that's somewhere between a $600K expense. We had a really large roof for a multiplex we had, and that was $16,000. So again, reserves are super important. But that consistent cash flow from the long-term rentals was really important to me, where you can predict that and you can put your reserves away consistently.
Sure. Okay. So then you went into, now you're doing it as a mostly syndicate. So how were you able to buy that,
The large ones. Yeah.
the
So
large
that
ones?
was a
Yeah.
syndicated deal. There were also partners on that deal. So it was a multi-partner situation. For that one, when it comes to partnerships, you just got to know who your partners are and know what their roles are going to be. I think most deals that are larger have multiple partners. And I always talk to people when they're going into an investments as a limited partner. It's really tough because you don't always get all of the information that you would want to have. So make sure that you ask a ton of questions and that you have as much information as possible. But it gives me a lot of sympathy for folks who are like going into passive investments, because as an active investor, I have only ever passively invested in one deal to figure out what it was. And I realized that I am someone who likes to buy, acquire, and manage these properties. And I think there's a level of control you have there as a natural operator. But I think what the benefit of being a passive investor is, if you find a really good operator, then you can let them do what they like to do. And then you get to enjoy the returns without having that constant worry. Because honestly, the portfolios are a lot to manage and most people don't like doing it. And it is, unexpected things like roofs, toilets, leaks, floods, they all happen. And it isn't something that you can necessarily plan for, but you can come up with a mitigation plan. So we have what happens if plans, but there's always surprises. I mean, they will all multifamily will always surprise you.
Yeah, no, for sure. Talk to us a little bit about the healthcare transition too. I mean,
Yeah.
obviously, nurse practitioner, by trade. We're talking a little bit before the podcast. You're looking to start your own practice and then decided not to. Can you talk to us why that? And then have you, I guess, from what I'm hearing, in the medical professional field, is once they leave the medical profession, you could have a per diem, situation.
Mm-hmm.
They always kind of not necessarily come back 100%, but it's always still there, and you do miss it. So can you kind of talk about why you decided, okay, I'm going to do this instead full time? Because that's Alex, that's a big change. So
I don't think it's for everybody. So I was telling you that, there was this moment where I realized I wanted to do something more than what I was currently doing, my current role. And this might happen for a lot of people in medicine, is that you kind of get into a rhythm. You're really good at it. You go in and you can do it pretty much in your sleep. And there's also a level of where else can I go with this career? And so the natural push was, okay, I could start my own practice, but it wasn't going to accomplish the things that I wanted, which was scalability. And I wanted it to be something that would provide me with an opportunity to really grow a lucrative business that was able to employ other families, able to grow. It's really tough to make that work in medicine. The incentives really aren't that aligned between patient care and business. And I think that's also something I struggled with too, is that healthcare by nature is really not going to be something that is profitable. And I don't really think it should be, but that's a personal opinion. And so I think that's where I was looking at all the other businesses I could potentially open or do. And I was already investing in real estate, already doing multifamily, had already explored all these other asset classes. And that's when I started looking at my mentors who were doing much bigger things than I was doing. And I was like, how do you do it? And they're like, other people's money. And that's where I really started understanding that there is a business that you can create for multifamily investments or any real estate investment that you're willing to open up to investors. And so that's where I just read a ton, learned a ton, asked a bunch of questions, read a ton of books, and really got what I would say is a deep knowledge and education on that. Similar to when you're studying for anything that you want to pursue. If you want to do it, you want to learn about it, you can do it.
Sure. No, I love that. That's awesome. As we wind down the show, how can my audience reach out to you, connect with you, learn more about you?
I would love it if you reached out. So you can do it on a couple different ways. My website is greywhalecapital.com. So GREYWHLE Capital. Otherwise, I'm also on Twitter and Instagram. My Instagram is Alex Moore Invest. My Twitter is Alexandra Kara Moore, or is Alexandra Seymour. I forgot.
Well, we'll have a link to all the social media links that you just mentioned in our social medias. We'll dig them up. And
Awesome. Thank you.
on our platforms as well. And if you liked what you heard and or saw today, please give us a rating and review on iTunes. It'll help Alex and I get our message out to a greater audience. So really appreciate that. Definitely encourage you to reach out to Alex, and looking forward to seeing what you accomplish in the future.
Thank you. I really appreciate it. It was great being on.
Take care.